The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. This is our once every 3 weeks members-only workshop. Thank you for coming. Let's talk about our agenda for the day. We're going to look at some charts. We'll talk about what else is happening, look at what sectors and industries are hot right now in the market. And then the rest is member-driven content, questions, things about the site, anything that you're curious about. You can put it in the question box now. You can put it in the question box if me talking inspires you to think of some question you have. Yeah, also, thank you to the people who submitted questions ahead of time. You get probably a slightly better answer if you do that. There's obviously no problem with submitting them during the presentation. But yeah, just send in those questions and mention the workshop, or just respond to the workshop invite is actually what a lot of people do in terms of getting those questions in. All right, let's look at some charts. Well, we seem to be hitting highs and lows with these presentations. We were near the low 2 workshops ago, and then we were nearer to the high a couple of weeks ago, and we're sliding again. So yeah, there's not really a whole lot to report here. I would expect some support at this level, which happens to be 3,900 on the S&P. It's also some technical support there in addition to being a round number. But yeah, that's kind of where I would expect that to go. The NASDAQ looks pretty similar. It's a little closer to a level that might represent some support. We'll have to see how that goes. The Russell, less so. The Russell has been kind of weird. It's actually still off its lows more than the other major indices, but has sort of less potential support between here and there again. 1,800 certainly is an important number. And I think the news is really what's driving things. The Russell, being a index primarily of small caps, is probably the one that gets whacked by the Fed the most. We'll talk about why that is in a little bit later. S&P 500 versus the S&P 500 equal weight. So the reason for looking at this is the top several companies are disproportionately represented, just because the S&P 500 is market cap weighted, so those bigger companies tend to get a heavier weighting. So you can see here more recently the S&P 500, which is the blue line, has been underperforming the equal weighted index a little bit, and that is probably because the top of the S&P 500 is tech stocks, which have not been doing particularly well. All right, growth versus value. This is the one that I think is the most interesting and telling this time around. For most of the year, value has outperformed growth. The year-to-date line here. I think the divergence was probably the widest at the lows for the market, and it was, it narrowed more recently, and it seems to be widening out again. Again, the Fed and higher interest rates and a quest for tighter financial conditions is pretty much the explanation for that. There isn't a whole lot of other reason for that to be happening in terms of what's happening in the economy. It is largely just an issue of money getting more expensive. Okay, so sectors and industries that are hot right now. First, let's show you where I found those. If you go to the sector and industry page on our website, you've got the sectors listed here. The top industries are here. You can look at any of the scores and how they're rated. What we're going to look at here is the short-term technical score, which looks at the last month or so of trading. And if you want to see what's hot in a particular industry, you can click through and see that just by clicking on that, the name of the sector, to click through and see the industries that make it up. And then you can go down another level if you want, if you just want to see the coal ones, you can go down like that. Anyway, let's talk about this list. Yeah, so energy remains at the top, with coal also remaining at the top. Oil and gas midstream, that's a lot of storage and pipelines, things like that. And then refining and marketing. Crude oil prices have come down. Gas prices have also come down to some degree, but the spread between the two remains relatively wide, which is good for the refiners. And so that's probably why that is there. Next is utilities, regulated gas, independent power producers, regulated electric. The one that's kind of interesting here is the independent power producers. These are companies that aren't necessarily a utility that provides power to homes or businesses. They essentially are, as the name suggests, independent. They generate electricity and then sell it to somebody else who's operating an electric grid. So when it gets to be particularly hot or particularly cold, those independent power producers tend to do more business because a lot of electricity demand is around heating and cooling. But yeah, gas and electric, this is largely about bills that people will keep paying regardless of, if you're worried about a recession. It's also a thing that typically tends to pay a dividend and isn't overly exposed to interest rates. Financial services, the shell companies here is interesting. We'll look at that in a second. It's mostly SPACs, banks, and financial data and stock exchange. The banks is a little bit interesting here. The yield curve being inverted and things like that. It's typically not great for banks, although banks have shifted since the financial crisis to generate a lot more revenue from fees and services as opposed to just taking advantage of different interest rates. So the fact that the economy is still relatively healthy probably helps them out there. And then financial data and stock exchanges tend to do well in times of volatility, which is certainly a thing that we are seeing now. The SPACs are interesting. Let me go here. We'll look at the shell companies. So some of these are post-merger, right? They have names, but a lot of them still say something acquisition corp. But if we look at this guy, basically what's happened is a lot of these are coming back up to $10. So these special purpose acquisition companies, they merge or they held an IPO, typically at $10 a share, and then they go look for a company to merge with. You can see all of these are right around $10. And in a lot of cases, the stock has come up recently to something approximating $10. And the reason for that is SPACs were really hot at the beginning of 2021. That has since tapered off, but companies tend to have a limited amount of time to complete a merger, or else they have to return the money to investors. And so what you're seeing here is a bunch of things that people were kind of down on because they were just pots of money that were looking for a company to merge with, and the market went down. So all the values of those companies that you imagine you might merge with goes down. But as you get closer to the deadline for the company to either merge or return the cash, the value of the asset essentially becomes basically $10. And so these things they're hot right now only because they were doing really bad for a while, and now they're back to basically their IPO price. I wouldn't expect them to go much higher than $10 because there's no reason for them to go higher than $10. What you'll get back if a SPAC cashes out is $10 plus interest less some amount of expenses. So it's basically right around $10. Next on the list is real estate. Again, some of that's about interest rates, some of it's about safety. Real estate's, or the REITs tend to pay, pretty decent dividends. That's how they're structured. There's also some tax advantages to that structure. And so that's why they do well there. It's interesting that the specialty REITs are still at the top. A lot of those are companies that have a bunch of different properties. And so if you're seeing something like we're seeing now, where there's still a large number of workers who will work from home and maybe permanently work from home, demand for things like office space maybe falls. And so companies who have properties that can be repurposed are probably going to do better than somebody that just has offices. Specialty also can include a lot of things like data centers or some warehousing and some other stuff also falls into that category. And then retail and hotel and motel. Again, these are indicators that the consumer remains relatively strong in this economy. And then lastly, industrials, infrastructure operations and industrial distribution are both essentially supply chain things, right? Which it all kinds of flows back to the consumer. In terms of what's driving that, people want stuff, and so ports and other companies that distribute things are doing pretty well. And then uranium, a lot of that has to do with the energy situation, particularly in Europe, where they still have a decent number of nuclear power plants and may be essentially not shutting some of them down. I don't think anybody has really moved particularly far in the direction of building new ones yet, although that conversation will probably happen. But with the situation in Ukraine and energy prices being high, both Europe and I think Japan are talking about either restarting or not shutting down some plants, which obviously increase the demand for uranium. All right, what else is going on? Interest rates, inflation, Federal Reserve continues to be sort of the main story. I think the Jackson Hole meeting and then the president of the Minneapolis Fed, whose name is Neil Kashkari, was on a podcast, a Bloomberg podcast. I think the episode came out today, but there were some transcripts that came out earlier this week. And yeah, the Fed wants to be taken seriously about this inflation thing. They want you to believe that they are going to get inflation under control and they're going to keep raising rates. And just because stocks go down doesn't mean they're going to start lowering rates. And the Kashkari comments were sort of interesting because he said, I don't want to, I'm going to get the quote wrong, but he said something to the effect of he was happy or glad stocks going down after Powell's remarks last week at Jackson Hole was what he was looking for. Higher stock prices is generally not compatible with, that should say tighter financial conditions, not higher stock prices. But yeah, higher stock prices is not really compatible with tighter financial conditions, and tighter financial conditions is what the Fed is shooting for. That doesn't necessarily mean all stocks go down, but certainly some, and maybe it does mean all stocks go down, some just don't go down very much. Otherwise, the inflation data is generally moving in the right direction. The labor market still looks strong. The Fed, I think, would generally like to see it a little bit weaker. We got a number earlier this week about job openings that was, I think, very high and higher than most people expected. One weird thing about job openings is it may be a less reliable indicator of the job market than they did previously. It costs essentially nothing to post a job opening at this point. And so, when I was starting out, you had to buy ads in a newspaper or do some other thing like that, whereas now you just post a thing on your website and it's essentially free to have job openings. So that may be a different, that number may be less reliable than it has been in the past just because the cost of posting a job opening is essentially zero. All right, there's also still some talk about a recession. We seem to have gotten over the argument from earlier this month about whether or not 2 consecutive quarters of a shrinking economy constitute a recession, but most of it seems to be forward-looking at this point. What I can say with some certainty is there will be another recession. When is the tricky part. That I think is anyone's guess. The Fed has been pretty gentle recently in terms of, obviously they have maybe been gentle to a fault in the sense that they are, now on this quest to be taken seriously about raising rates and trying to stop inflation. So we'll see how that develops, but I don't expect they're going to just sort of let a recession happen. I think there's some balancing that they will do in terms of, how weak does the labor market need to be and how consistent does the data pointing to inflation shrinking need to be before, before they stop raising rates. And then, energy prices remains another issue. It is a particularly big issue in Europe where they have all kinds of problems because they're pretty reliant on Russia for a lot of natural gas and oil, which they're trying to use less of. Some of that could spill over to the U.S. to some degree, especially when cold weather comes. The other thing is, I think if you look at gas prices over this year and look at particularly the survey-based measures of inflation, so like consumer sentiment and some of those things where they, ask people what they expect about inflation. It turns out when gas prices are really high, people feel like inflation is terrible. And when they're lower, they feel less bad about inflation, even if prices for other things remain relatively high. So that's a big thing. It can be a driver of both the stock market and also the market for other consumer goods, just because people tend to be particularly sensitive to gas prices because it's a thing most people need. It's also probably the only price that most people see, in letters that are 3 feet tall displayed all over town. They don't put the price of milk on a giant sign in huge numbers. So gas is the one you see. You really notice when that goes up and down. All right, so that is it for the prepared remarks. Let's get into the questions. So we got a couple from Ralph, which we'll start with here. So he said, what's the best way to predetermine rising stocks for the next day? He says, IO predictions often rise before the market opens for public trading. As such, is there a chance for next day predictions or next day stocks to think about? Yeah, so the first thing is we don't really make predictions. We've gotten a number of questions just, from our, support channels recently about predictions, and a lot of them seem to be looking at the quotes for futures in the morning update, which is posted on the website. You also get it by email, but essentially this piece, futures are pointed higher, futures are pointed lower, and then we have the what the futures are looking like for the morning up or for the day. So the futures are a separate market from stocks. It's essentially a sort of a side market, so you can bet on the price of the S&P 500. It's interesting because the futures trade basically 24 hours a day, 5 days a week, whereas stocks only trade 6.5 hours a day, 5 days a week. So the futures are essentially people betting what stocks will do. And then the stock market opens, and sometimes they do the thing that the people were betting on in the futures market, and sometimes they do a different thing. Sometimes it's because there's new information that comes out. Sometimes it's because the people in the futures market tend to be pretty different people than the people who are in the actual stock market. There aren't a lot of retail investors trading index futures 24 hours a day. So it's just groups of people with different outlooks. We also have a list of stocks that are moving pre-bell. In most cases, what you'll find is those stocks have some sort of news about them that day, right? Either they've reported earnings since the previous trading day, either that morning or the evening before, or there's some other news about either the company or sometimes oil prices would go way up, and so all the energy stocks are up, things like that. But yeah, so those are just reports on what's happening in different markets. They're not intended to be predictive so much as just, hey, here's, it's very much here's what the weather is right now, and much less here is what we expect the weather to be. If you are trying to figure out what stocks will move tomorrow, I would suggest looking at things like the earnings calendar. And so for today, the 31st of August, if I was looking for stocks that are going to be moving tomorrow, what I might want to do is the stocks that have a time of AMC, which is after market close. So I'd want to look at those, and then for tomorrow, I would want to sort by time and find the opposite, which is BMO, so that's before market open. That'll tell you which stocks are moving. For the direction, you're going to want to look at, how the results actually come in. So it looks like we have some of these. But yeah, so we've got the estimates and the actuals here. That's not necessarily always the entire story, so you're probably gonna want to click through and see if you can find the earnings story, which, yeah, most of the time it's here on the news page. I would click through and take a look at that to see, if it's actually a beat or the numbers look good, but then somebody said something that was less exciting later, because that kind of thing does happen pretty frequently. We also have the FDA calendar that you can look at, which again can help you try to find things that are going to happen. Again, though, that will give you a list of things that might be moving. They won't necessarily give you a direction for that. You're going to have to try to find what the actual news is, which again should mostly be on the news pages, but after the reports have come out. The sentiment score is another way. You can look at things. It's less useful for things that are in the news, because news tends to trump sort of technical analysis or things like that. But yeah, the sentiment score for things that don't have a lot of news can be a good way to find things that are sort of, trending higher or trending lower. If I was going to look for, just without knowing anything about news or anything else, just guess which stocks will go up tomorrow, I would probably guess that a lot of the stocks that went up today will also go up tomorrow, because you expect things to be relatively the same day to day. Another thing I will say, though, is that none of these are foolproof, right? Predicting the future is notoriously difficult. And the shorter term you're looking at, the sort of more randomness there is to stock movement, the harder it is to predict. The one thing I can tell you is good companies tend to gain value over time. So that is sort of the tenet of the core tenet of most of finance and investing is, right, sort of buy and hold investing, where you just hang on to things, and the good companies go up over time, and hopefully you don't buy stock in bad companies. Also, though, it turns out that stocks can double and triple, whereas a bad company can only go down 100%. So you can have 200% gains, and you can only ever lose 100%. It's cold comfort if you have actually lost 100%, but that's why buy and hold tends to work better than a lot of short-term trading strategies. So Ralph also asked how to manage a covered call after a steep drop. So the first thing to consider really is, do you still like the stock, right? A covered call is mostly a long stock position. So if you no longer feel good about the stock, just don't have that stock anymore. I feel like I talk to a lot of people, and I hear from a lot of people who are like, well, how do I fix this? And sometimes you lose and move on, right? Like, the best way to not take the best way to not take 100% loss is to sell at some percentage that's less than 100. So just, insisting that something is going to be right doesn't always work as a strategy. The other thing is you can sell more calls against the stock. We have on the website an out of the money covered call tool. So you can put in your on the options thing, out of the money. You can put in a cost basis. So let's say you bought Apple at 175. I don't know that that's even possible, but let's say it is. Hit position repair and calculate, and it will find a call that is, that should make your position profitable, right? So the 175 call, you get a new cost basis of 170, 175, which you can use next time if you want up here. And if the call happens to get assigned, you'll also make a profit that way. Those are basically the two ways to do it. You don't have to use the call from the out of the money call calculator, but sell more calls against the stock and try to lower your cost of ownership while also hoping the stock rises are basically your options there. All right, so Dinkar sent in a number of questions as well. We'll go through those, and then I see the questions stacking up in the chat. We'll get to those in a few minutes. Is the stock and option information based on the previous day market closing price or the next market open price? So yeah, we don't know the market open price, so it's based on the previous day's close in terms of the scoring and the options trades. They're based on the closing prices. We're working on a big project right now that will hopefully eventually allow us to have both intraday scoring and more intraday trades. The Investors Keyhole service and the trades in the portfolio, those are generated and published by our analyst team. So those use real-time data, but the stuff in like the stock screener and stuff like that is all based on the previous day's close. Yeah, for number 2 here, why are the option strike prices mostly in the money? He says, I trade bearish credit options on out of the money strike prices. In the money will be very risky. This is true. I'm confused about why he says they're in the money though. Because our credit spreads are all written out of the money. The debit spreads and covered calls are frequently in the money or at the money, but you can go, especially if you want bearish credit spreads, you can go to the options screener and click on bearish verticals, which are going to be credit spreads, and these will all be out of the money. Also, if you go to an individual stock page, bearish vertical, so the stock price here is right 160, 162. Yeah, okay, so that's out of the money because it's a put. Wait, no, that's actually just because the stock fell today. Is what's happening there. But yeah, they're intended to be out of the money. Sometimes the stock falls overnight, and so it's not out of the money for that reason. But yeah, that's generally the reason that would happen. All right, let's see here. And yeah, the strategy for our option suggestion, each strategy is different. The covered calls and short puts are written near the money to capture the most option premium. They are sort of, they're relatively neutral strategies. You don't need the stock necessarily to go up to make money from those strategies. They do carry significant risk sort of to the downside for the stock. So it should probably be a stock you'd be okay with holding for a while anyway. The diagonal spreads are synthetic covered calls. The nice thing about the diagonal spread conceptually is it's also available using puts. So you can make a bearish trade on a stock that you maybe don't have the best feeling about, but it doesn't really have to go down for you to make some money there. And yeah, the credit spreads are different in different places. The IK trades, that's the Investors Keyhole. You should be getting those in your email if you're an option subscriber. Those are pretty far out of the money. The screener and portfolio trades are closer to the money and usually shorter. Closer to the money tends to require a little bit more sort of care and attention in terms of managing them, whereas the ones in the Investors Keyhole service, the returns aren't huge, but the success rate tends to be much higher than something that's a lot closer to the money. Yeah, so not receiving notifications, you can go to My Account and click on Message Settings. And here's a list of all the messages you should be getting. You can turn them on, which is blue, or off, which is gray. I get these to several different email addresses. That's why this account is turned off. But yeah, that's that. If you have the thing turned on and you can't find the email, you may want to check a spam or junk folder. Gmail has some other side folders, in particular updates and promotions, that things tend to show up sort of randomly. If there's a specific email, stocks to watch or morning update that you think you should be getting, and you have the thing turned on and you just can't find it, let us know and we might be able to investigate further. But most of the time it's either stuck in spam or it's been turned off somehow. And then what is the most appropriate, effective method to trade weekly credit options? Yeah, I mean, the option screener absolutely is a great place for that. Go to strategy. If you want bearish credit spreads, you hit bearish verticals. There's 1,600 of them today. If you want the short ones, you can look at something like things that expire before September the 16th. We can look for a return rate of better than 30%. Say for bearish, maybe you want an overall score below 40 and you want a key rating above 4. Yeah, there's 112, and you can sort by days to expiration if you want to find some super short ones, or you can sort by the overall score if you want to find just the worst looking stocks. Oh, I went the wrong way. Here we go. Yeah, so that's the kind of thing you can do to try to find those. I mean, yeah, it really depends on sort of what your strategy and preferences in terms of weekly. A lot of people say weekly and they mean 3 weeks or they mean 3 days. So it's hard to know exactly what you might mean there. But yeah, the screener has trades of almost, yeah, shoot to fit almost every need, I think. All right, so the first question here is about American Virtual Cloud Technologies. Yeah, so the question is specifically about this sort of exploring strategic alternative thing. So exploring strategic alternatives is code for we are either in whole or in part for sale. Typically, the reason for that is you think that the stock is trading for less than the company is worth. In this case, the stock went way up afterwards, although given recent history, it's probably not way up enough. I don't know a ton about this company to really tell you. Yeah, I mean, yeah, to really tell you whether the assets are worth more than 45 cents a share or not. But that is the kind of thing you expect. You don't necessarily expect the stock to go up 43% based on some strategic alternative talk and management change. But you do a lot of times you do see stocks go up after some kind of announcement like that, just because yeah, just because typically the goal of some transaction like that is to unlock some value that isn't, available through the equity, just the equity price. So yeah, if the company is sold, what will happen is you'll get, there will be some per share cost, right? So somebody will come in and, like Elon Musk offered to buy Twitter at $54.20 per share. So in that case, in cash, and so in that case, every shareholder of Twitter gets $54.20 for every share that they have. Sometimes you get a stock transaction, so you might get some shares in a different company. Sometimes it's a mix of cash and stocks. So you would get some shares and some cash. But those are typically the ways those things work, is you get whatever the purchase price is. Charles says he has a vertical credit spread on Chevron, which is down. Yeah, so Charles, yeah, so he got the trade from the sort of preferred personalized trades over here. I think it was obviously a vertical spread of some sort. Yeah, and look, there's CVX again today. So the fact that that's there today means we think it might be a good trade today. It doesn't mean that you should necessarily try to roll into that position. If you can roll into that position and try to break even, it might work. I generally don't love the roll on a vertical spread because it tends to be you either are putting capital in or widening the spread, which is sort of a shadow way of putting capital in to just have more at risk on a stock that just went against you. So I don't necessarily love rolling just as a strategy. If you still like it and you think it might bounce a little bit, it can work. But what you're doing essentially is you're closing a spread and then opening a new spread. So the fact that they're both on Chevron, I guess it feels like a win to turn a loss into a break even. But basically you did one trade and then you did a different trade and the net result was you broke even. So if it's on Chevron or if you picked Apple or IWM or some other stock and broke even, the ultimate result ends up being basically the same as far as I can tell. So yeah, you certainly could do that, but these trades are ideas for sort of new positions each day. They're not intended to be updates to previous positions. We'd like to get there at some point in the future, but we have some technology work we need to do before we can do that at the sort of scale of 3 trades times 9 strategies every day. That's going to be some work to get that in place. We've got, I think we know basically how to do it, but we just got to get somebody to write all the computer code. So Robert says, where do you find the stocks that are getting beat like BBY that you make good money via swing trading? So BBY is down today after earnings. So yeah, the earnings calendar is the kind of place where you could look for that. You could also look for, very high or very low sentiment scores. Again, that can be another way to try to find things that are sort of trending to do some swing trading. Let's see, Ahmad says Faraday Future. So Faraday Future, I looked at, somebody sent in a question about this ahead of time, but I didn't have a chance to put it on a slide because it came in pretty late. But yeah, this company is kind of interesting. I believe, based on the fact that they were one of those SPACs, right? So the stock traded for a little less than $10 and then it went up and now it's gone back down. But yeah, so what I typically like to do for companies like this is, one, understand that the reason a lot of companies go public via SPAC as opposed to IPO is that the disclosure requirements for going public via SPAC are less. And also you're allowed to provide projections about the future, which you're not allowed to provide in an IPO. And yeah, you can just go look through some of these documents here that they have filed. So yeah, this I read earlier. They're making progress toward equipment installation in their factory, which is well and good, I suppose. Let's see here. I think it was this one I looked at earlier. So from a little over a month ago, started production and deliveries are now expected to commence in the third or fourth quarter. Well, we're most of the way through the third quarter, and this was a month ago. They were going to deliver cars in the third quarter, and now they're still setting up their factory. So obviously the fourth quarter is still out there, but I don't think they have started production. Which is not to say this is a bad company. It's just to say that it is a company that, let's see if we can find something that contains financial statements. Not there. Yeah, another thing, so an S1, which is what this is, if you look at this Edgar page from the SEC, an S1, anything with an S is what's called a registration statement. So that's the company saying, hey, Securities and Exchange Permission, we'd like to sell some securities. Here's some information about those securities. Is this okay? So things I like to look at are summary, risk factors, and the other one is use of proceeds. So in this case, the company is going to sell some stuff, and then some other people are also going to sell some stuff. This one seems to mostly cover other investors selling some warrants, which is part of the SPAC thing. But yeah, let's see. They changed auditors recently. That's, again, people change auditors. That's fine. It can be a red flag. I don't know that it is here or not. All right, so 10Q is a quarterly report. That should ideally have some financial statements. There's a balance sheet. Yeah, so the thing that I'm not seeing on this statement of cash flows here is revenue. That's typically a thing you like to see a company have. Obviously, all companies start out with no revenue, but it means this is a very risky bet, right? They're burning somewhere around $141 million a quarter, or at least in the last quarter. But yeah, at 294 for the 6 months into June 30th, they burn about $100.5 million a quarter, and have no revenue. So they're probably going to have to sell shares, which means that your shares get diluted, which means the price goes down. It's very risky in any case. It's very risky, and it's probably a long-term play. It's really impossible to know if it will work, but it's the kind of thing that should be a relatively small part of your portfolio because it is very risky. Obviously, if they make a great car and they sell a ton of them, it has the potential to be a great business, but this sort of thing is, again, very risky. We also have some questions about Plug. Plug is interesting because because its stock chart looks like this. And if you go out further, it looks like that. It's pretty wild how volatile it has been over time. And that's because, well, this keeps changing, but now they're building an end-to-end green hydrogen ecosystem. Green hydrogen is a thing that I had never heard of until about 6 months ago. What it means is hydrogen, but hydrogen that we're getting from environmentally friendly sources as opposed to just burning natural gas, which is how a lot of hydrogen was being generated previously. Obviously, if you're burning natural gas to make hydrogen to power cars, you might as well just burn the natural gas to power cars. You're not really doing much for greenhouse gases. So, they've added green in here. But yeah, like these plans sound good. Build and operate green hydrogen highways, but not 100% sure what that means. Right? Are they going to actually build roads? Are they just going to build cars that work on highways? I don't know. It's unclear to me. This is another company. I believe Plug does actually have some revenue. But yeah, it's also a thing that gets just pushed around a lot. It's see if I can make this a little bit bigger. Oh, that was the wrong direction. All right. Yes, so they do have some revenue, but it is, yeah. They have a loss before operating expenses, which is never really good. Typically, you would like the cost of revenue, and ideally, you'd like for your expenses to be less than your revenues, much less the cost of your revenues to be less than your revenues. But yeah, like this is another company that loses money. It's possible they can do some of that and become a profitable business at some point. The stock absolutely swings around a lot. It seems like the sort of thing if you were trying to do swing trading, it might work, but I'm not. Yeah, I think the infrastructure for hydrogen is much further away from being widely accepted than the infrastructure, or widely in place than the infrastructure for, say, electric cars. It's possible the future has some hydrogen cars and some electric cars. I don't know. I don't know enough about hydrogen cars really because I've never seen one. I know there are a few out there. I think Amazon has some hydrogen powered vans or is buying some hydrogen powered vans. They're also buying electric stuff though. So, it's possible it could work. Again, though, it's pretty risky and should probably be a pretty small part of any kind of portfolio that you're putting together just because it's a company that loses money and has to raise capital fairly often. And so that's going to have to turn around before the stock really takes off on a consistent basis, right? Like if you want to try to catch one of these and ride it from, 25 to 60, if you can call the bottom and the top, you can make a lot of money that way. But it's difficult. All right, so somebody says Advent in green hydrogen. I don't know about that either. I guess it's probably this one, right? Yeah, okay. I guess the chart here looks about the same. Well, it's pretty ugly. Yeah, this is another company that was a SPAC merger, right? You can see where it traded along at right about $10, and then people got excited about the merger, and then all the SPACs sold off at the beginning of this year, and now it's trading for a third of the IPO price. Yeah, again, like the company loses. Yeah, I don't really have much to say here. The company loses money. I don't know that they have any sort of, actual business operations. They say they are actually generating revenue, but It's hard to know how much that is, right? Like we just looked at Plug, and Plug actually has negative revenue, right? Like if you consider the cost of sales in there, they're, you know, essentially losing money with every sale they make, which isn't great. It's hard to see how a business like that scales. It's not to say it's impossible, and it's not to say they can't turn it around. It's just, again, the kind of thing that's very risky, particularly in a time when the Fed is trying to tighten financial conditions, right? So tighter financial conditions typically means less money sloshing around in the economy, which means less people who are willing to invest in speculative technologies at high valuation multiples. So that typically means when I say, the Fed is looking for lower stock prices, it's lower stock prices for things like this in particular, right? Coca-Cola or General Motors or something that like is a profitable company that generates cash. They don't have a lot of borrowing costs. Their borrowing costs will go up as interest rates rise, but they're not funding themselves with equity like a lot of these companies are, right? Like a lot of these companies have to sell stock, which means that you're going to get diluted anyway, and then they're going to come out and sell that stock at a somewhat lower valuation. It's not, it's not necessarily a recipe for a rally. It's not to say it can't swing around like we've seen with all kinds of things, but you're definitely going to be fighting the Fed on a lot of these small speculative names. All right, I think. Okay, so we did have one question here: how to pick a replacement for a covered call if not enough capital. It's a good idea to buy 10 spreads. So, yeah, if you don't have enough capital for a covered call, yeah, it definitely depends on the spread. If you say you're buying the spread, I assume you're looking at a debit spread. So in terms of a diagonal spread, one of the advantages to that is the capital is less. But one of the advantages to there being less capital is certainly you can do it with a smaller portfolio. Also, you can spread your money around. I probably wouldn't go buy, if I couldn't buy a covered call on a stock that I liked, I probably wouldn't go max out my account in a diagonal spread on that stock. I would probably, if I could afford one spread there, I might do it, and then I'd go find another stock I like and do that, because that's diversification. Right, the diagonal spread, what you're making money from is essentially selling option premium. And so you're making money, basically, the stock doesn't really have to go anywhere, you make money from time decay. And so doubling down on that kind of thing isn't really helping. It actually works better if you if you kind of spread that investment around a little bit, because if something does happen with your stock, you've got multiple stocks essentially instead of just one. All right, so we're getting pretty much toward the end of this. I don't see any more questions. If you have one, get it in now. This is being recorded. We'll post the recording tomorrow on the website and send everybody an email with a link to see that recording. It's just a YouTube video. It shouldn't require any special anything really. Just be able to watch a YouTube video. So yeah, we will send that out tomorrow. If you have questions between now and the next workshop, which will be in 3 weeks, you can use this help button. We get back to them pretty quickly. Most are same day in terms of answering questions. So that's a good way to get in touch with us. Thank you all for coming. Thank you for subscribing to Investors Observer, and I will talk to you again soon.